it really feels like a lot of folks trying to buy a home in 2025 are facing a pretty uphill battle.
Oh, absolutely.
We're seeing mortgage rates that are, well, making those monthly payments increasingly difficult, especially, I think, for middle-class buyers.
It's a real squeeze for so many aspiring homeowners right now. It truly is a challenging environment for, a big part of the market.
Definitely.
But what's interesting, I find, is that while affordability is such a major concern for some, there's this different segment, wealthy investors, who often operate with a completely different playbook.
Right.
They're not necessarily feeling those interest rate hikes in quite the same way. And they often use strategies that look, well, quite different from the norm.
Exactly. And that's really the focus of our discussion today, isn't it? We're not going to just rehash the standard advice.
No.
Our mission in this deep dive is to try and uncover some of the more, let's say, nuanced and sophisticated real estate investment strategies that high net worth individuals seem to be utilizing in 2025. We want to understand how they're approaching the market.
Yeah, and to get a clearer picture, we've looked at quite a range of sources, things like Forbes articles on current real estate trends, insights from various wealth management firms, and even some, interesting discussions happening on investment forums where these kinds of strategies are talked about.
Okay, so our aim then is to pull out the key insights from all that, maybe break down these more complex approaches so they make sense.
Right.
And ultimately offer everyone listening a glimpse into how this sort of different tier of the real estate market actually functions.
Precisely.
So where should we start? To kick things off, what are some of the specific strategies that are, particularly popular among these wealthy investors right now?
Well, one area that consistently draws significant interest from high net worth individuals is luxury real estate.
Okay, luxury. Makes sense.
Yeah, we're talking about the really top-of-the-line properties. Think exclusive villas, amazing penthouses, substantial estates, but in prime global locations.
Like where specifically?
Places like New York's Upper East Side, London's Mayfair, Dubai's Palm Jumeirah, or maybe Marbella's Golden Mile. You get the idea.
Right. The best of the best.
Exactly. These assets, they're characterized by, superior quality, high price points, obviously, sought-after locations, and just a certain level of inherent exclusivity.
That makes intuitive sense. There's always a market for the absolute top tier, isn't there?
Pretty much.
But beyond just the, the prestige factor, are there other reasons why this sector is so appealing to them right now?
Oh, absolutely. Beyond the prestige, luxury real estate in these prime spots often acts as a kind of safe haven asset, especially during times of economic uncertainty.
Ah, interesting. Like a stability play.
Sort of. Unlike maybe more volatile market segments, the demand and, importantly, the value retention in this top tier tend to be more stable. So it makes it an attractive long-term holding for preserving capital.
Okay, so it's a tangible store of wealth that might also appreciate.
Exactly. Think of it that way. It's not just about having a beautiful property. It's also very much a strategic financial move for many.
Is there any, hard data that backs this up, this focus on luxury real estate?
Yeah, actually, the UBS Billionaire Ambitions Report from 2024, it indicated that a pretty significant number, 43% of billionaires, were planning to increase their investments in real estate in 2025.
Wow, 43%. That's nearly half.
It's a substantial portion, yeah. It shows that the world's wealthiest are really seeing property as a key part of their overall financial strategy.
So besides just owning these incredible properties, are they doing anything specific with them? Any particular tactics?
Well, one thing we're seeing is this growing demand for luxury short-term rentals.
Like high-end Airbnb.
Kind of, yeah. Data from places like AirDNA points to this increase. It suggests that, high-end travelers are increasingly looking for these exclusive kinds of accommodations.
So owners can generate income from the property while still holding on to it.
Exactly. It allows them to leverage the asset for income generation, too.
Okay. Now, shifting gears a little bit. One strategy that came up in our research, and it sounds a bit complex, was the strategic use of trusts for property ownership. How does that work? Why is it appealing?
Yeah, this is where things get particularly strategic, like you said. Land trusts are a good example. Basically, an individual, they call them the grantor, creates this trust and transfers ownership of their property into it. Then you have a trustee who manages the property based on the trust's rules, and then beneficiaries who ultimately benefit from it.
And the advantage for wealthy individuals is?
The primary advantages usually boil down to liability protection and privacy.
Privacy. How so?
Well, by holding the property within a trust, That direct link between the owner's name and the property can be obscured. It offers a layer of insulation from, say, potential legal challenges or just unwanted attention.
So a degree of anonymity and maybe shielding other assets, too.
Potentially, yes.
Yeah.
And then there are the tax implications, which are a whole other layer.
Right. I was going to ask about that.
Yeah.
What are the tax considerations with trusts?
Well, there are definitely transfer tax things to think about. For instance, if a trust owns a property and a beneficiary gets to live there rent-free, the tax authorities might see that as a distribution of income from the trust to the beneficiary, which has tax consequences.
Okay, that makes sense.
And this is especially relevant for things like generation skipping trusts. These are often set up specifically to minimize certain transfer taxes over multiple generations.
So trustees really need to know what they're doing.
Oh, absolutely. They need to be aware of all these nuances to stay compliant and, make sure the trust achieves its intended tax benefits. For these ultra high net worth families, these trusts aren't just about maybe avoiding estate taxes today.
Right.
They're really crucial tools for planning generational wealth transfer, managing assets, protecting them for future generations, potentially mitigating really complex tax burdens down the line.
It definitely highlights the complexity and, like you said, the need for some serious expert legal and financial advice.
No question. It's not DIY territory.
Okay, so our sources also touched on some other specific strategies beyond just holding luxury properties or using trusts, things like leverage deals. Can you explain how wealthy investors use leverage?
Sure. Leverage in real estate, put simply, just means using borrowed money, usually a mortgage, to finance buying a property.
Okay.
The basic idea is that by using less of your own capital up front, you can potentially amplify your returns on the total investment.
Amplify returns.
Yeah.
How does that work?
Well, think of it like using a small down payment, that's your equity, and borrowing the rest to control a much larger asset. If that asset's value goes up, your return on your initial smaller investment can be significantly magnified, like, using a lever to lift something heavy.
Got it. So potentially bigger gains on your own cash.
Exactly. Places like CC&L Financial Group suggest that when it's managed carefully, leverage can be a really strategic tool.
Yeah.
It helps access more capital, maybe diversify a portfolio.
But borrowing always comes with risk. It can't be all upside.
Absolutely not. And that's the critical part. Origin Investments, for instance, really emphasizes the potential downsides of high leverage.
Like what?
Well, if the market turns down, those highly leveraged investments can lead to substantial losses. Your debt doesn't shrink just because the property value does.
Ouch. Okay.
Plus, in the current climate, with rising interest rates, refinancing existing loans can get much more expensive. That can squeeze cash flow, impact profitability. It's a real risk right now.
So it's about being strategic and prudent with borrowing, not just maxing out debt.
Precisely. It's a balancing act, maximizing potential returns versus carefully managing those debt risks.
Okay. That makes sense. Now let's explore another area our sources brought up, niche real estate markets, and these strategies like forced depreciation. What do that involve? Sounds active.
It is very active. Forced depreciation is basically where investors don't just wait for the market to lift their property's value, they actively work to increase it.
How?
Well, Azibo outlines several ways. One common method is through really strategic renovations. Things that add tangible value, like adding extra bedrooms or bathrooms, maybe updating kitchens, improving curb appeal.
So physically improving the property to make it worth more.
Exactly. It's about being an active manager of the investment, proactively increasing its worth through smart improvements and also operational efficiencies, not just relying on broader market trends.
What else besides renovations?
Another key tactic is optimizing the rental income.
Raising rents.
Well, yes, but strategically. By doing thorough market research, maybe using tools like Privy's Live CMA, investors can see if their rents are below market and adjust them accordingly based on comparable properties.
Okay. Data-driven rent setting.
Right. And also actively managing and reducing property expenses. Things like improving energy efficiency, water usage, tackling maintenance promptly, that all boosts the bottom line and makes the property more valuable overall.
It sounds like a very hands-on approach to investing.
Yeah.
Much more involved than just buying and holding.
Definitely.
Our sources also briefly mentioned something called the BRRRR method. Can you give us a quick rundown? The name is memorable.
It is. BRRR stands for buy, rehab, rent, refinance, repeat.
Buy, rehab, rent, refinance, repeat.
Yeah. UCEM suggests it's a potentially scalable strategy for generating pretty significant returns over time. The process is basically You buy a property that needs work, usually below market value.
To buy.
Right. Then you rehab it and fix it up to increase its value and make it rentable. Then you rent it out to start generating cash flow. Then comes the refinance part. You refinance the property based on its new, higher appraised value.
So, culling equity out.
Exactly. You pull cash out from that refinance, and then you use that cash, hopefully tax-free, to repeat the process, buy another distressed property.
Okay, I see the cycle. You're using the value you created through renovation to fund the next deal and scale up.
That's the core idea. It leverages the increased value to expand the portfolio. Sounds effective, but obviously requires managing each stage well.
Yeah, seems like a lot of moving parts.
It can be. But these more active strategies, like forced appreciation and BRRRR, they represent another way that savvy investors, including the wealthy ones, can navigate the market and potentially generate strong returns even when things feel challenging economically.
Okay, let's quickly touch on a couple of other areas mentioned. What about international real estate or things like syndicates?
Yeah, those are definitely in the mix too. International investing is interesting. That UBS report we mentioned earlier noted some billionaires are actually increasing exposure to real estate in developed markets overseas.
So diversifying geographically.
Exactly. It can be about finding opportunities elsewhere, maybe geo-arbitrage, taking advantage of price differences between markets, but it comes with its own complexities.
Like what?
Well, financing foreign property can be tricky. Currency exchange rate risk is a big one. Fluctuations can eat into returns.
Right. The exchange rate could move against you.
Definitely. And you absolutely need local legal representation. Different countries have vastly different rules for foreign ownership. Places like China, Portugal, Singapore, even the US have specific regulations.
So more complexity, more risk, but potentially diversification benefits.
That's the trade-off. And then you mentioned syndicates. Real estate syndicates are basically a way for investors to pool their capital together to invest in larger deals than they could handle individually.
So accessing bigger projects by teaming up.
Essentially, yes. A sponsor finds and manages the deal, and multiple investors contribute equity. It allows access to potentially higher return projects like large apartment buildings or commercial properties.
And finally, what about technology? Are data-driven platforms playing a role?
Increasingly so. Forbes has highlighted this trend, platforms using AI and machine learning to analyze vast amounts of data to identify promising real estate opportunities, predict market trends, and even manage properties more efficiently.
So using tech to get an edge.
Yeah, bringing big data analytics to real estate decision-making, it's another layer of sophistication.
Okay, so let's try to bring this all together. We've covered a lot of ground. We've seen that while many people are grappling with affordability due to rising mortgage rates,
Yeah.
wealthy investors in 2025 are often playing a different game. They're using sophisticated strategies like investing in high-end luxury real estate, sometimes as a stable asset.
Right, for capital preservation.
Strategically using trusts for things like asset protection, privacy, and generational wealth transfer.
Key tools for them.
Carefully using leverage, borrowed money, to potentially amplify returns while being mindful of the risks.
A calculated risk, ideally.
And actively working to increase property values through forced appreciation tactics like renovations and rent optimization, or using methods like BRRRR to scale portfolios. Plus, exploring niche areas like international markets or syndicates and using data platforms.
That sums it up pretty well. It's a very different landscape at that level of investment, isn't it?
It really is.
And it really underscores that these strategies often involve complex financial and legal structures. Understanding the risks is paramount, especially with leverage or those international deals with currency fluctuations.
And you definitely need the right advisors.
Absolutely. Expert advisors specializing in these kinds of alternative assets, robust governance structures, especially for family offices managing significant wealth. It's all part of the package for managing these complex strategies effectively.
And we didn't even dive deep into the tax side, but it's clear that the tax implications of different ownership structures like trusts or strategies involving foreign property are incredibly complex too.
Oh, massively. Things like whether you get a step up in basis on assets in certain trusts or how foreign rental income is treated. It requires very specialized tax advice.
So this whole deep dive really offers, I think, a fascinating glimpse into how access to significant capital and sophisticated planning allows for a very different approach to real estate.
Definitely. It goes way beyond the concerns of the typical home buyer just trying to navigate today's interest rates.
So maybe a final thought for our listeners. Considering these insights into the strategies used by, the very wealthy,
Mm.
what potential future shifts or maybe broader impacts might we anticipate in the real estate landscape?
That's a great question.
Could understanding these advanced approaches, even if they aren't directly applicable to everyone, offer any kind of inspiration or maybe lessons for a wider range of investors as they navigate their own real estate journeys?
It's definitely something to chew on. Could some principles, maybe around active management or strategic diversification, be adapted even on a smaller scale?
Perhaps. It's certainly something to consider as you think about the ever-evolving world of property investment.